is waiting for the market to improve. Everybody wants the market to improve. Everybody is hoping and wishing and praying and doing everything they can to get the market to improve. However, it's not improving. And we got whipsawed this week. If you've studied with me before and you've taken my class when we talk about market risks and volatility, you know that when volatility expands out, let me do it in front of my face so you can see my fingers. When volatility expands out, you get whipsawed, and that's, you know, literally like a saw. So volatility is bad for the markets. It generally leads to declines in the market, and it generally and I always remind everyone of the math. If the market's going up 20% and then down 20%, you don't break even on that trade, you lose money. Do the math. If the market goes down 20%, then up 20%, even the opposite, you don't break even on that trade, you lose money. So you got to do the math. So big moves are not the friend of the market, and they're not the friend of investors. What the market needs is low volatility, predictable earnings, slow earnings growth over time, little baby steps back and forth, 1%, 2% up and down days, not 5% or 10% moves, which is what we've been seeing in recent weeks. So it's been a little bit tricky. It's been a tricky market. Anyway, so I collected a bunch of little tidbits from what was going on this week to kind of try to explain what was going on this week and what we should probably try to expect for next week. So let's see. I honestly, I hope next week calms down, but we've got a lot of things that are going to happen that we'll talk about in a minute. But most notably, though, we've got the Fed meeting minutes coming out, which are going to be very hawkish. They're going to indicate future rate hikes. All week long this week, we've had every single voting member of the Federal Reserve giving a speech somewhere and talking about how inflation is too high and they need to get inflation down. And we've got the same thing next week. They're all going to be out there talking. And we've got earnings season beginning. Usually when earnings season begins, it starts with the banks. And so we've got several banks reporting next week. Earnings season is kicking off. That's going to create some volatility in the markets as well on Thursday and Friday. So get ready for that. It should be like the beginning of the week should be like kind of calm, but by the time we get to the end of the week, it's going to be crazy again. And we'll see what happens. I don't really imagine that we're going to have an earnings season where banks are going to say, hey, everything's really great and we're going to earn a ton more money than we did last year. That's what they should be saying because interest rates are higher, but that's probably not what they're going to say. I think, though, they're going to say that credit risk is not a big problem because that's the big risk we have next week is if banks say that credit risks are too high and they're having a lot of defaults on their loans. That's what we do not want to hear. We don't want to hear that. So keep your eyes and ears open next week. All right, so let me flip through some slides real quick. I've got a couple of videos, a couple of news clips. We can talk about what's going on. If you guys have any questions, you can feel free to raise your hand at any time electronically, or you can just unmute yourself and talk. That's fine. You can ask a question anytime you want. That's what I'm here for. It's just a little market update so you guys know what's going on. But I guess maybe what we should do first is, or should we do this first or last? Should we check our stock track? You guys tell me. Do you guys want to see what's going on in our investment competition right now? Or do you want to see it later? I'll be honest, I'm almost afraid to look. We can check later if you want. It's fine with me. I'm going to peek right now. I'm going to take a peek. Okay, hopefully you guys still are not all investing in Apple and Tesla because those stocks are not, Oh my, all right, you know what? All right, let's just get this over with. Let's look at this right now. Later, last. Okay, all right. Thank you, thank you for the comments in the chat. All right, so let's talk about what's going on in the markets, and then we'll look at what's going on with our investment competition. And then we can talk about if you guys have any questions about any other investment things that are going on in other investment competitions. All right, so I'll share my screen and we can see what's been going on. So look, you guys have been watching the markets for a while now. You've taken some classes, you've done some work, but you can clearly see that the market was just screaming to go higher. And anytime, look, we got some very basic technical analysis here, where we're looking at on the top, we've got the S&P 500, we've got the Bollinger Bands, which are 2 standard deviations above and below in terms of volatility. And on the lower side down here, we've got our relative strength indicator. And these are 2 really good technical indicators. If you listen to Mark Arbiter's talk later tonight, he gives a speech every Sunday as well. He's more of a technical expert than I am, obviously. But nonetheless, even though I'm a fundamental guy and I look at the top down, the macroeconomic view, and I look at the earnings and things like that, you still have to kind of look at the technicals and see what's going on. And you can see anytime the market has been oversold here or here, where it's like broken through its bands, it wants to rally higher. It really wants to. People want to believe that the market's done going down. It touched it here, and the market had a little bear market rally. And everybody want to believe that the market's gonna touched it here, and the market rallied a little bit, and it touched it here, and we had a bear. This is a good bear market rally. That was a tradable rally. And we got ourselves into the same kind of position here earlier this week, where the market volatility got really down. Oh, we're way oversold again, and everybody wants to believe we're so oversold that the market has to rally. This has to be the bottom. But no, it doesn't have to be the bottom. The bottom can be much, much lower. And in fact, it probably will be when we start cutting our earnings estimates. Nonetheless, everybody wants to trade the market higher. And the problem we have is multifold. First of all, the earnings are not coming in. Second of all, the Fed is not going to pivot and cut interest rates. They're not going to do that. Inflation is still red hot. And so despite everybody's best expectations, the third problem, whenever there's a market rally, when somebody has been suffering through this, and then they see the market rally by 5% or something in a couple of days, the first thing they want to do is cash out. And we saw a lot of that by the end of the week. So we had a nice little rally, and here's one of the reasons why. This was the craziest headline I've ever seen, and I can't imagine why the market would rally on this news. The UN calls on the Fed and other central banks to halt interest rate increases. Now, okay, I understand why if you're really hyper optimistic on the Fed pivoting and starting to cut rates, this would be an exciting news bit for you. However, the Fed is not run by the United Nations and never will be. And so they have no say whatsoever in this. None. They're just making up crazy stuff. Because what they're afraid of, and believe me, this is a legitimate fear. What they're afraid of is that by increasing rates here and in other countries, we'll see currency price appreciation, which we have been seeing, and it will cause so much financial strain on other economies that somewhere, some other country will have their economy break down and their currency will get crushed. And it almost happened in the UK last week. We talked about that briefly. The UK the central bank had to step in and prop up the pound sterling. So that is a potential problem. And that's something we do have to be aware of and cognizant of. But I mean, look, it's not our problem. We're not there. We're here in the US. Everything's fine. Our currency is going up. That means the price of imports are going down. That's getting inflation under control. The price of oil has been going down. I don't know if that's going to be the case next week. I don't think so. Talk about that in a second too. But because we're getting inflation under control, our currency, everybody else in the world who's an investor in other economies is suddenly realizing that the US economy is strong and the currency is going to go higher and inflation is going to get under control here before it is anywhere else. And they're selling their currency and getting into ours. Will that break something eventually? Yeah. Is that our problem? It's not our problem. It's somebody else's problem. It's somebody else's problem. I understand why the UN wants to intervene, but it's not our job to prop up the economies of other countries. That's their job. They all have their own central banks and their own money printing machines. Anyway, so like you've realized, and I know you were watching the markets every day this week, when that news came out, there was like a huge surge in the market. It was just amazing. And even though the market cooled off by the end of the day, and the next day it rallied even higher. And I know everyone wanted to think that the Fed was going to listen to the UN, it was going to stop hiking rates, and then therefore the economy would not have a recession, international economies would be fine, everything would be great again, and the market would go higher finally, because as we just looked, for technical reasons, it was way oversold. It was due for a little rally. It was due for a little bear market rally. And was it a tradable rally? Yeah, for a couple of days it was. And by trading, I mean, you should have sold everything. Because by the end of the week, economic data came in really good. The jobs report was pretty solid. Everybody realized the Fed's not going to cut rates. In fact, they're not going to pause. They're going to hike rates, and they're going to hike them even more. And so the market kind of rolled over and then barreled. And then, yeah, so we ended up pretty much right back where we started, even though it was an exciting week and it was a little bit of a good time to buy and sell stocks. We could have traded some stuff. I don't know. I don't think we're at the bottom yet. And so one of the things that came out was the job openings. And so let's start from the beginning. This is the other bit of news that like caused markets to rally, especially in the early part of the week, because this was on Tuesday. We had job openings, and it came in lower than expected. And I guess a lot of people expected, wow, you know, if there aren't many job openings, then maybe the Fed will stop hiking rates. But there's still 10 million job openings, so it's sort of a false sense of security. It's weird that people thought this was a tradable piece of news, but they did. Between that and the news from you know, outside of our Federal Reserve Bank, it's weird how that really caused a market rally in the beginning of the week. Anyway, here's the news report. Let's listen to this real quick.
Yes, let's start with Joe. Job opening, labor turnover. Of course, this is an August number, always 2 months in arrears. Expecting a number slightly over 11 million. And consider every month this year has been over a million. Until now, 10,053,000. 10,053,000. First time since September that we are under 11 million, a still very solid number, but it does underscore a slight deterioration in what has been, and to some extent continues to be, a very tight, good jobs market. With 10 million, slightly over 10 million openings, and we know that there's 6 million people out there that may be looking, we could see the inequitable arrangement between those two metrics. Factory orders for August expected unchanged is unchanged. That comes off of -1%. That was the first negative number in that series since September of last year.
Look at that market rally.
Transportation, it increases to up 0.2. And that, of course, is your August. Now let's go to durable goods. And durable goods
NASDAQ was up 3.2.
Final reads. Durable good orders expected to be down 0.2%, delivered exactly that, down 0.2%, which matches the mid-month read. And prior to that, we were down 1 0.1%, so back-to-back negatives. Strip out transportation, though, and like factory orders, it improves. The up 0.3%, up 1.4 in capital goods orders, non-defense ex-air.
All right, I don't think we need to hear the whole report. I just want to point out the fact that we're in, if you're in the YEFA server and you look at the memes, you obviously saw I posted memes recently, and one of them was, bad news is good news, changed my mind. And also good news is bad news. We're in that sort of environment again, where bad news is good news. And because the jobs report came in worse, slightly worse than expected, still really good, but was slightly worse than expected, and some of these other numbers came in a little worse than expected, the market rallied. It was so oversold. People are yearning for the market to go higher. But this is not strong enough of a negative report to get the Fed to stop
for business and capital spending. 1.4 solid numbers. This series has been
all right. So, here's the thing. When you look at it, so the job openings have sort of rolled over, but look where we have been recently and where we are now. There are so many unfilled jobs. It's incredible. This little teeny downturn here is not going to cause a decline in wage inflation. And that is the biggest fear of the Federal Reserve and any bank around the world. If we get back to a situation where we were in the 1970s, for example, where everybody is demanding a raise all the time. In fact, the unions are getting it baked into their contracts. And they say, we have to get a wage increase every year, commensurate with the price of inflation. And then you cannot get inflation under control. It's really hard to do. So this is the biggest fear. So we're still at an elevated level of job openings, and there are not enough workers. And so, this is like an epic move higher since everybody basically retired and went away during COVID. And it's a problem. So anyway, then later in the week, things started to get worse. And then this became a bad news is bad news situation. And one of the biggest things that happened this week, and this is kind of an exciting thing for an investing point of view, is that OPEC decided to cut production by 2 million barrels a day. Now, what has been happening, and I should have a chart on this, but I didn't produce one, unfortunately. What has been happening is that the Biden administration has been trying to tamp down gasoline prices. And, yay, that's good, because gasoline prices were way too high. But they've been doing that by, instead of increasing production, by releasing reserves from our strategic petroleum reserve, which is there for emergencies, like if there's an embargo or there's a war or something like that. But they decided that gas prices were too high, let's just release some oil. And they've been releasing 1 million barrels a day on average every day. And so that's what the price of oil has gone from the 120s to the 110s, to the 100s, the 90s, to the 80s, and it touched the 70s briefly, if you recall, a couple of weeks ago, and that's back up in the 80s now. And this has really annoyed all of the other oil-producing countries. And so they had a meeting, and this week they decided that they're going to cut production because the price of oil is too low. This is going to become a problem for us. But it does present an opportunity for you as an investor. So a couple months ago, when the price of oil started coming down a lot, I remember clearly stating that oil, if you were in class with me, you probably remember me saying this, that the energy complex was uninvestable at the time. Well, guess what? It's suddenly highly investable now. If OPEC cuts production by 2 million barrels a day, what's going to happen is the price of energy is going to go up. Our domestic production is going to go up. Volumes flowing through pipelines is going to go up. Unfortunately, the price of oil and price of gas is going to go up, but you can invest in these companies again because things are going to get better for them.
The watch is on for some of these deep supply cuts. Our Brian Sullivan is still in Vienna, Austria with the latest. Big day, Brian. Good morning.
Yeah, Carl, it really is a big day, and I know the price of oil is not moving a whole lot now, but the price of oil has moved $10 a barrel in the last couple of days on this expectation, and we are expecting a cut of about 2 million barrels per day. Now, the 2 million barrels is not going to come off the market because a lot of these OPEC members are not hitting their quotas anyway. Call it 50 to 60%. So if that's the case, Carl, we're talking about maybe 1.3 million physical barrels a day actually coming off the market. Now, are they expected to do it all at once? No. All of our sources telling us, the delegates that we have texted and talked to say this is probably going to be a rolling 2 million barrels over a certain amount of time, but focus less perhaps on the number and more on the symbolism, guys, of this. OPEC was an organization a year and a half ago, where they're talking about OPEC's dead. The UAE and Saudi Arabia are fighting that the organization is outlived its course and is done. We're seeing the Saudi minister arrive. We're seeing the Russian minister arrive, by the way. This is OPEC saying, not only are we aligned, we're aligned with Russia. By the way, bringing the ties closer together with Russia. U.S. is going to be very upset about that, but also that we are in charge of at least half the global oil market. This is, unfortunately, a direct rebuke to the White House, who, by all reports, Kayla Tausche reported the same, was trying desperately to stop this production cut. It's happening, guys, and it's happening in a tight market. I have never seen a cut when the market is as tight as this. This can only be seen as sending a pretty loud message.
So many cross currents here.
Yeah, so, all right. This is a huge issue for us and for everyone else in the world. Well, so for investing competitions, I know we're talking about sustainability, and almost all the other major investment competitions this year are, excuse me, are focusing on some sort of sustainability. And this is probably not the best area in which to invest. And I would have agreed last week that it's probably an area to avoid investing. However, that has changed dramatically. It's changed very rapidly. I'm not saying that these are suddenly sustainable companies, but what I am saying is that they're investable companies. Chevron, ExxonMobil, all those major oil companies and major oil producers in the U.S. are suddenly going to become a lot more profitable. It's inevitable. There's nothing that we can do about it at this point, because the OPEC cartel has exactly countered our releases from our strategic petroleum reserve. So, and that authority ends, I think, after November. So those are going to stop, and then the market's going to be really tight, and that means oil prices are going to probably shoot higher, maybe up into the hundreds again, or maybe to the 120 level by November, December of this year. So it's going to be an issue. Now, who does that hurt? Well, it hurts consumers. So that might have a negative impact on consumer discretionary stocks, for example. But directly, who does it hurt? It hurts companies like airlines, because that's their largest expenditure. Fuel, jet fuel. It's a huge, huge expense for them. Airlines have really benefited recently. And when we looked at the inflation report last week, you can remember we highlighted that food companies were able to pass inflation through. They're making more money, their stocks are going up. Airlines are not only, they're benefiting twofold, because first of all, people have been locked up at home for a couple of years, and now they're getting, people want to go back to their family reunions, their class reunions, their weddings that have been put off for 2 years, the vacation they've put off for 2 years. People want to travel. And so people are flying. Airlines are taking advantage of this and raising their prices. And at the same time, their biggest expense, the price of oil, jet fuel, is coming down. And so they've not only been able to pass through big price hikes, but their costs are going down. That might reverse now, because this could be a problem for airlines. So that could impact them negatively. Okay, Twitter acquisition. This is the other big news piece this week. So Elon Musk finally said, okay, I'm just going to buy Twitter at the agreed upon price. What? He filed a 13D with the Securities and Exchange Commission and said, basically, I'm just going to buy it, whatever. And so
as we speak, we're just getting some breaking news on this front. The filing is out, the 13D from Twitter that we've been waiting for, David.
Yeah, I have been. I'm reading it right now. Probably came out as you and I were talking. Very straightforward, and 2 paragraphs is what we're talking about here. Gentlemen, and it's sent to Simpson Thacher, of course, the lawyers for Twitter, on behalf of X Holdings and so on and so forth. They basically say, hey, we're ready to move forward to proceed to close the transaction as contemplated on the 25th of April. That's when the deal was signed, the merger agreement, on the terms and subject to the conditions set forth therein and pending receipt of the proceeds of the debt financing. So, Sarah, very straightforward. This letter does confirm what we've been telling people and basically is now simply in the hands of the court and the lawyers for Twitter, and is just subject to them making sure they feel safe, almost in a sense that if we drop our litigation, you're going to go ahead with this, right? I'm sure that is the case. They have nothing to really be concerned about, one would expect, but nonetheless, you can also
they didn't get the
anticipate.
first time around either.
You're dealing with Elon Musk, right? The Musk parties provide this notice without admission.
I wanted to bring this news up for a couple of reasons. First of all, I mean, it is market moving news, but one of the problems is that whenever Elon Musk is buying Twitter, he's selling shares of Tesla. And usually what happens is the stock price of Tesla goes down a lot. And I just want to bring this to your attention because one of the most traded stocks, last time I checked, in our sustainability investment challenge is Tesla. And look, hey, Tesla's a great company. It's growing rapidly. And it's obviously promoting some sustainability because it's not using gasoline. It's an electric vehicle company. That's all great. However, I just want you to be aware the stock could come under pressure if Elon Musk goes through with this transaction and he needs to buy Tesla shares at an elevated price, which means he may need to sell more shares of Tesla in order to raise cash. Now, I believe he has the financing in place, and I believe he has actually sold enough Tesla stock that he can finance this deal. But I don't know for sure if that's the case. Everybody's kind of thinking that he's already sold as much Tesla stock as he needs to. We'll see. We'll see. Okay, so let's wrap up. There's a couple more things. So here's what happens. At the end of the week, by the time we're getting to the midweek and the end of the week, the numbers weren't as bad. In fact, they were pretty good. And that is the whole paradox of the good news is bad news and bad news is good news situation. We need bad economic news to believe the Fed will stop hiking interest rates. But by the end of the week, we were no longer getting that. We were getting actual decent news, okay news, and that's not good because that means the Fed is going to keep hiking interest rates, and they're probably going to hike them by 75 basis points in the next meeting.
And a little more economic data crossing the tape with ISM Services. Let's get to Rick Santelli.
Yes, and unlike the S&P Global Services PMI, which has been under 50, 56.7 is our September read on ISM Services Index. That's better than expected. And sequentially, that follows August at 56.9, and that happened to have been.
And remember, with this metric, anything above 50 is strong growth. Anything below 50 is contraction in the economy. So when he says 56,
the best going back to April, so these are good numbers, 56.7. And consider this, the global PMIs that we had about 15 minutes ago were the weakest 2 months ago since May of 2020. The last time ISM Services was under 50 was May of 2020. So definitely this is showing a more resilient services sector, and we want to continue, of course, to monitor that. It's the biggest swath of the U.S. economy. Morgan, back to you.
And so the dollar started to rally again, and the stock market rolled right
Santelli, thank you.
And started heading lower. And so to get then OPEC actually did cut. This is the price of West Texas Intermediate crude oil. You can clearly see what was going on here. There was a sharp downturn in prices for a number of reasons. One was that we were releasing extra reserves from our Strategic Petroleum Reserve. The second most important reason, most influential reason, I would say, would be COVID lockdowns in China. Nobody was traveling in China. Flights were canceled. A lot of flights were canceled, and nobody was driving anywhere. That caused the big contraction in demand. So supply was increased while demand was decreased. So supply and demand drove the market straight down. Now, what we're facing, and this is forward-looking, is the exact opposite. The economy is actually growing in the US. Looks like by the basis of that ISM number, growing better than expected. China's probably going to come out of the COVID lockdowns. People in this country are flying a lot. I mean, look at the demand. Look at how much they're raising prices for airlines, for air travel. And OPEC is cutting. So now we have the opposite situation where we've got increased demand and decreasing supply. And so here we go, off to the races. So yeah, suddenly energy is an investable sector again for a variety of reasons. And if you want to make this an investability, I'm sorry, not investability, a sustainability play, you can make the argument that oil is going to get really expensive and you should be buying uranium stocks and windmill companies, renewable energy companies, and things like that. Do the homework on the stock prices, though. Don't buy something that's trading at 50 times sales. Buy something that's reasonably priced. They might be cheap right now. I don't know. I haven't really looked. So and then the news just kept getting better, which means
all right, here we go. Non-farm payrolls for the month of September on the big jobs report. 263,000. 263,000. Now, if we go back, this is really fascinating because 263,000 is the low water mark. Going back to April when it was 263,000, 208.
So just remember what happened at the beginning of the week was with the jolts, the job openings number. It was a little lower than expected. It went from 11 million to 10 million, and that drove the market up a lot for 2 days. But then it turns out nobody lost their jobs. There's no unemployment. This is a really strong report, and this drove the market straight back down.
88,000 is private payrolls, and if we look at the change in manufacturing payrolls, it's about as expected, a pretty robust 22,000. The unemployment rate, or U3, is 3.5%, equaling the July read, which is the low water mark, and in this case, bad news.
He just said it. Hold on, let me back up so he can say
the July read, which is the low water mark, and in this case, bad news, good news, good news, bad news. Yep, maybe you don't want to see unemployment rates moving.
Okay, so I know that it's counterintuitive for some of you who haven't been through this process before. Why would great economic news make stocks go lower? Normally, you would expect, and I would expect, that good economic news is good economic news. Companies are going to earn more money, their EPS will rise, their dividends will be increased, share repurchases, all of these things, and therefore the stock prices will go higher. And yes, that is the normal thing. But what's driving the market right now, more than anything else, is inflation and the Federal Reserve trying to combat inflation. And if there's a rule in the stock market, it is, well, there are several rules, but here's probably one of the biggest ones. Don't fight the Fed. You will not win. If you think the Fed is going to raise interest rates, stocks will go down. Companies will go bankrupt. Unemployment will increase eventually. And by virtue of this report, where there were no people filing for unemployment, the Fed is going to raise interest rates. It's going to be a problem for the stock market for a little while. Surprisingly, lower unemployment claims, that'll be a hiking. It's the same as last month. It's the same as this month. That'll be a hiking. You're going to get a hike. The market's not going to like it. And there's not a lot we can do about it. And remember, rule number one, don't fight the Fed. This, though, is why the market rallies on, it's like a hairpin curve. Is the second that there's bad news, even slightly bad news, people really want the Fed to stop hiking, and then they pile back into the market, and there's a market rally. And all of these bear market rallies keep failing, keep failing, keep failing. And I think what's going to happen is we're going to see earnings estimates decrease. We're going to learn a lot starting next week when earnings season begins. And we're going to see if companies' earnings come in lower than expected. And if that happens, we're going to see share prices go significantly lower. All right, let's not even watch this. I don't even want to watch this one. Let's just go to the next one. All right, so so here's the other thing that's kind of weird. So the Dow theory, don't forget, is when it's mostly related to freight and to the transports. And so what the Dow theory says is that you need one index to sort of substantiate what the other index is doing. And in this case, we've got a weird situation where the Dow Transport Index actually went up, but the freight rates and the freight levels and volumes are actually collapsing, which I think is incredibly bearish. And if nobody's buying things and we have demand destruction because of inflation and transportation.
One more thing before we go, and that is the state of freight. Transport's widely viewed as a recession indicator. They go down, so does the economy. But they are handily outperforming the S&P at the start of the fourth quarter. But with reports of FedEx lowering its guidance yet again, is this trend going to hold? Frank Holland has been following the story. Frank.
Hey, good afternoon, Tyler. You know, as you mentioned, FedEx shares trading lower after a Reuters report. The company plans to warn about lower holiday peak volumes on October the 21st. As you can see, rival UPS shares hit even harder, falling 3.5%. I've been in contact with FedEx, and they say the company is updating individual contractors that operate their residential e-commerce focused ground network to help them adjust staffing. Remember, back in September, CEO Raj Subramanian issued a very dire warning about softening freight volumes globally, even warned about a coming recession. In a statement, FedEx said in part, weakening macroeconomic conditions are causing volume softness. We are constantly collaborating with customers on their projected shipping needs and making adjustments as necessary. But I also spoke with the incoming CEO of RXO, a digital freight brokerage. He says the freight slowdown actually has two sides.
If you think about the market loosening up a little bit and the load to truck ratio falling, that allows you to expand your margin. Typically, you pull down your transportation costs faster than what.
Okay, he's just talking his book. Basically, though, if you remember the Dow theory from our classes, the transports lead the economy. And that's one of the first indicators of economic strength or weakness. If transportation volumes are increasing and prices are increasing, that means more things are getting transported to factories, from factories to stores, from stores to consumers, and the economy is roaring back to health. What we have now is the opposite situation. The transportation stocks are down because they're doing less volume. Freight rates are down because they're doing less volume. The iron ore is not coming out of the mine to the smelters at the steel plant, and the steel factory is not putting things on trains to go to the auto plant or the plant that makes refrigerators and air conditioners and microwaves. And so the factory, that's because the plant that makes the refrigerators and the microwaves isn't selling things because people aren't buying as many houses, but not building as many houses. So look, the whole economy is slowing down. It's causing a ripple effect throughout the economy. This is one of the surest signs that the economy is really slowing down.
What your customer
It wasn't
fall.
the biggest slowdown enough to
one more thing
to cause the market to rally, though, because you know, there are other things impacting the market all week. Anyway, let's get on to what we should be looking for next week. Let's wrap this up at like quarter of. Let's talk about what's going on next week. Well, earnings season is starting again. We've got some big companies reporting next week. So this is, I think, Wednesday's report. We got Pepsi. PepsiCo's a huge company. Their earnings are expected to go up to $1.84. We'll see what happens. Then we have in the next day, I believe this is Thursday, a lot of companies start reporting. We got Taiwan Semiconductor, a tremendously important company. Wells Fargo, huge financial company. BlackRock, huge financial company. Progressive, big insurance company. Walgreens Boots Alliance, a huge healthcare company. Fastenal, Delta, Domino's Pizza. So we have some really big companies starting to report next week, and we're going to have to pay attention because we're going to find out really quick if the economy is getting worse or if it's getting better. Because each one of these companies is going to have a conference call, and they're going to tell us if things are getting worse or better. And I imagine some of these companies will disappoint. And look, some of these are big Dow companies, and some are not. Like Taiwan Semi is not a Dow company, but the other ones are. Some of the other ones are. And then Friday we get, as usual, when the earnings season kicks off, we get a lot of the big name companies and mostly the financials. So we've got JP Morgan Chase, we've got Morgan Stanley, we've got Citigroup, PNC Financial, US Bancorp, First Republic Bank, like all big financial companies are reporting on Friday. You got to pay attention. And United Health, also a Dow component. So we've got another, besides Walgreens, Boots, United Health, also like probably one of the second largest healthcare components for the healthcare sector. So if you're looking at healthcare stocks, you got to watch those two on Thursday and Friday. It's going to be important. All right, what else is going on next week? We've got a lot of stuff coming out. We've got, especially the FOMC minutes. When this comes out, the instant it comes out, and this is the weirdest thing, is that always comes out in like the middle of the day, not before the market opens or after it closes. They release this in the middle of the day. And people write algorithms with AI to parse through the verbiage and see which words change, and if the words got more negative or more positive, and then they initiate trades based upon that, which is weird. So there's gonna be some volatility on a Wednesday as well. And then we've got, of course, our CPI stuff. That's gonna be huge. So the middle to end of next week, Wednesday, Thursday, and Friday, is gonna be really tough. Really tough. It's gonna be a very volatile market. We got retail sales and consumer sentiment. All right. So let me wrap this up real quick by talking to you briefly about what else to expect, and then we'll look at our stock track account. So next week, I've got some notes here. We've got JP Morgan Chase, Citigroup, Wells Fargo. It's a very busy earnings week. We've got the FOMC minutes. We've got speeches from Federal Reserve officials, a lot of them. Inflation rate data, retail sales data. In the UK, we've got unemployment, industrial production, and GDP figures. And we got data coming out of China as well. So it's going to be a busy week. It's going to be very volatile. And so just be cautious for the next week. If next week comes out pretty good and things start to stabilize, it's going to be a lot easier to make better investment decisions. Right now, it's a situation where caution is warranted. All right, so let's see real quick how you guys are doing in our stock track, and we can see. All right, you guys are trading Tesla and Apple, Amazon, Microsoft, and Nvidia. These are the companies that did great during COVID lockdowns. I'm not sure those are the companies that are doing great right now, I'll be honest. It's mostly food companies, energy companies are going to do great right now. I know Tesla is a great one for sustainability. Let's face it, Nvidia, listen, it really benefited from two things. But people, when they got locked at home and had to work from home and take school from home, you needed new hardware, you needed new graphics cards. Plus, people were using graphics cards for Bitcoin mining, and Bitcoin was, like 4 or 5 times higher than it is right now. Now that the price of Bitcoin has come down to 8,000. Yeah, nobody needs an Nvidia graphics card. They're selling them on the market at discounts. All right, you guys even want to see? Len, mute your microphone for goodness sake. What are you eating, dinner over there or something? Wow, some of you guys are doing great. I haven't even checked this before class. I'm so happy to see this. Wow, actually, a lot of you are doing really well in positive territory. Some of you are up 1%, 2%, 4%. Wow. All right, this is a lot better than I expected. And you guys are making a lot of trades. Wow. Brendan, thank you. 71 trades. You're really cleaning house with that. Jeez. And a lot of you have just made 1 or 2 trades, and that's fine. A lot of you have made no trades. Now, listen, this is an investment competition. Make some trades. If you don't, you're going to get DQ'd, okay? You're going to get disqualified. It is an investment competition. And I know that caution is warranted for the next week, but that doesn't matter. Just buy some stocks that are not really that volatile. You'll be fine. You'll be fine. Over the long term, stocks go up, right? So you'll be okay. All right, so let's look at the all right, I hate to see this, but I want to look at the, let's see if we go down to the bottom here. Let's see what happens. Oh, not too many people negative. All right, a lot of people not doing anything in the stock market right now, unfortunately. All right, so you guys have to get busy. You gotta do a lot more stock investing. You're doing a pretty good job so far, I have to admit. So, all right, so that's it for the market update.